Now, this is important, especially when making mortgage decisions right now. The Bank of Canada just did something that they have never before done in their history, and that's release a summary of the conversations they had with respect to the most recent interest rate increase. And this conversation sheds significant light on the conversations being had by the governors of the Bank of Canada, which is important for Canadians going forward. And what I'm going to do is I'm going to be your translator from economics to plain English so that you can understand exactly what they're debating and what it means for you going forward with respect to interest rates. But before we get into the details, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So please do me that favor and hit that subscribe button and hit that like button so more people like you can see this video. And don't forget, for a limited time, you can go to mortgagesecrets.ca and get my brand new book for free. All you have to do is pay the shipping and handling. At the end of the month, this is going to go onto Amazon, and when it goes onto Amazon, the offer is gone forever. So go to mortgagesecrets.ca in order to get your copy. Okay, so let's get right into it and discuss for the first time ever the summary of the deliberations that were had by the Bank of Canada. And this comes on the heels of the International Monetary Fund recommending to Canada that they start releasing summaries of the conversations that were had. This creates greater transparency, but don't be fooled. The information in these releases is going to be just as important going forward as the information that is released when the actual interest rate decisions are made. So while we'll get an overlying view of what the conversations that were had were and what the key risks are, the actual conversations and the debates that were had won't be known to us. And what I've done is I've put this together in a format that will make it as easy to understand as possible. So let's start first and foremost by looking at the notable developments that they discussed in their most recent meetings. So first and foremost were global energy prices, and more specifically, the declining global energy prices that is actually helping the fight against inflation. The second notable development is that supply chain issues are easing, especially as China starts to reopen. And on the note of China, China's new COVID policies, or more importantly, the reopening of China and the lack of zero COVID policy, is expected to have a pretty big effect on the economy, both in China and globally. Now, the Bank of Canada has noted that global growth has exceeded expectations, especially in Q3 of this year. This is true for Canada, it's true for the US, it's true for the Eurozone, and it's true for China. And by the way, China's growth is only going to get greater as the economy reopens, and that could have upward pressures on inflation going forward. So the Bank of Canada is paying attention to this closely. In fact, the situation in China was a big part of the document that was released. First and foremost, COVID's uncertainty and what it will look like with the economy reopening, the upside risk that this could have to oil prices. So, in other words, more demand from China on oil could lead to higher oil prices, which could put upward pressure on inflation. And then on top of that, increased demand pressure as the Chinese population starts to spend more money and consume more goods. And inadvertently, there's a really big case study on what happens when an economy opens up, because we saw this pretty much everywhere but China in 2021 and 2022. So it is expected that there's going to be a lot more demand pressure from the Chinese economy, which could potentially put upward pressure on inflation globally. Now, with respect to the situation in Canada, and you have to be careful here because what you need to understand about inflation in 2023 is that it is a global phenomenon. It is something that is being experienced everywhere. Quite often, you see high inflation in a specific economy, but in 2023, we're seeing high inflation all over the world. So it's not something that any individual central bank did that caused high inflation, but it is the global economic circumstances that were a result of the pandemic that have put us in this high inflation position. And specifically in Canada in Q3, we saw higher than expected GDP growth, but that is being mitigated by what seems to be the wage momentum plateauing. In other words, wages aren't increasing as much as they were in the previous year. And then we see inflation turning a corner. And that is where we saw inflation in the summer being 8.1% and it dropping down to 6.3% in the most recent data. So the overall outlook for inflation in Canada, if you look at it independently, looks pretty good. But you have to take into consideration those global factors. And that is what the Bank of Canada is discussing quite extensively when they're meeting for their deliberations. Now, they touched briefly on the key developments since the previous interest rate decision. First and foremost, they see global inflation declining, which is a positive thing for Canada and everywhere else around the world. And this is largely due to lower energy prices. Now, on top of that, we're seeing supply chain issues resolved. We're not seeing large amounts of ships being stuck at port. We're seeing the free flow of goods once again. And that is largely leading to fear in the markets declining, which again is a very positive thing from an inflation standpoint. Now, they had three key debates with respect to consumer spending going forward. First and foremost, they talked about 5-year fixed mortgages that would be coming up for renewal in the next 2 to 3 years. And those mortgages renewing at higher interest rates would have a reduced spending effect on the economy, which should help with the inflation outlook. And it's very clear here that they're watching spending closely, and they're also seeing that strong employment and higher rates of savings that happened as a result of the fear that was created during the pandemic could have a contributing effect to inflation. And it's also clear that they're watching the housing market very closely. They are concerned that housing prices could fall more substantially than expected, but they also point out the fact that higher rates of immigration should support the real estate market going forward. Now, they pointed out some key risks with respect to inflation remaining sticky and staying well above that 2% rate that they're aiming for. And that is first and foremost supply chain challenges, which good news here is it looks like supply chain challenges are starting to sort themselves out. Wage growth expectations, which could cause people to expect to earn more money, which would lead them to spend more, which would cause upward pressure on inflation, and then rebounding oil prices. So, in other words, higher demand for oil that leads to higher prices for oil, which leads to a trickle down effect, which causes almost all goods in the economy to become more expensive. And subsequently, inflation goes up, which could cause them to have to increase interest rates. So, now let's talk about the policy decision. First and foremost, they recognize that inflation is coming down, and the interest rate increases of the last 12 months have not been widely felt throughout the entire economy yet. So when they looked at whether or not to increase interest rates in January, they looked at their policy decision from the perspective of two dimensions. The first was whether or not to increase interest rates, and the second was whether or not they changed their forward-looking language. Now, obviously, we know at this point that they increased interest rates by 0.25%, and the rationale for that was twofold. First and foremost, the labor market is still tight and wages are still increasing. And second of all, GDP growth in the third quarter was higher than expected and is expected to be higher than expected in the fourth quarter as well. So as a result, they erred on the side of caution and increased interest rates one more time. And they've been very, very clear that they're going to continue to err on the side of caution. So in other words, they're more likely to increase interest rates than lower them in order to make sure that they don't get behind the eight ball on this, at least any further than they previously were. Now, with respect to the language changes, they wanted to make it clear that the bar to increase interest rates was now significantly higher than it was last year. But they also wanted to make it clear that they needed time to accumulate evidence to see whether the interest rate increases of last year were actually working and flowing through the economy. And I think most importantly here, they wanted to make it clear that this was a conditional pause in increasing interest rates, and that they are more concerned with the upside risk of inflation than they are with the downside risk. So in other words, what they are saying here is that they are more likely to increase interest rates right now than they are to reduce them, because they would rather increase them too much than not increase them enough and end up in a situation where inflation remains sticky and they have to do even more heavy lifting with respect to increasing interest rates. Now, there are many people throughout the economy that think that interest rates are going to come down at the end of the year or early in 2024. Tiff Macklem was very clear yesterday in his statements where he suggested that it was unwise to expect interest rates to come down anytime soon. Now, of course, he previously said not to expect interest rates to go up anytime soon, but here's the key point there, is sometimes what a central bank says is just as important as actually changing the interest rates. So the Bank of Canada is trying to manage expectations with respect to interest rates going forward so that people don't go out and make buying decisions based on the fact that they believe interest rates are going to come down and spend more money than they should, which would cause inflationary pressure. Now, this is important, especially when making mortgage decisions right now. Obviously, fixed rate mortgages are priced significantly cheaper than variable rate mortgages, with the 3-year becoming very popular. However, if you expect interest rates are going to remain high for a longer period of time, a 5-year would make more sense than a 3-year. Now, I did my monthly mortgage update, which I will link to right here, where we talked about the 3-year and the 5-year rates. Obviously, those 3-year rates are incredibly popular right now, but you should definitely be keeping in mind everything that the Bank of Canada talked about in this summary when it comes to making financial decisions of your own.